Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at WeRide.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Let's do it. So WeRide, they're positioned as this pioneer in L4 autonomous driving, but it feels like there's more to it than just that.
There is. The key thing to understand is that they are not a single product company. I think that's where a lot of people get it wrong.
Right. It's not just Robotaxis, which is what you immediately think of.
Exactly. Their product matrix is honestly pretty unique. You've got the Robotaxi, sure, but then there's the Robobus, these specialized robo-sweepers for city sanitation.
And robovans for logistics. That diversity seems central to the whole story.
It is, and what's so fascinating is how they pull it off. This isn't 4 different R&D teams working in silos.
Okay, so how does it work?
It's all built on one foundational system. They call it the WeRide One Universal Platform.
That sounds a bit like, corporate jargon. What does that actually mean for the tech?
It means the core software and hardware stack is vehicle agnostic. So they can take this central nervous system, basically, and deploy it on a car, a bus, or a van with minimal changes.
Which means every mile a robovan drives is actually helping the robotaxi get smarter.
Precisely. All that data feeds back into the same core system. It accelerates the learning curve exponentially.
And that speed is everything in this space. But there's another piece to this, right? The cost of physical testing is a huge bottleneck for everyone.
It is, and they address that with their WeRide Genesis simulation engine.
So this is how they test without actually putting cars on the road and spending a fortune on maintenance and potential accidents.
Yeah, you can run millions of virtual miles, test all these bizarre edge cases,
Yeah.
Things you'd never see in 100 years of real-world driving. It just pushes their tech forward so much faster and cheaper.
Okay, so the tech stack is efficient, but L4 robotaxi revenue, that's still a ways off on a mass scale. So how do they actually make money now?
This is where their strategy gets really, really smart. It's a dual commercialization approach.
Go on.
They co-developed an end-to-end AD system, so advanced driver assistance with Bosch.
So this isn't the full self-driving L4 stuff. This is the L2 or L3 assistance that's in new cars today.
Exactly. And the key part is that system has already reached start of production, or SOP. It's slated for mass production in 2025.
So that's a tangible, near-term revenue stream.
A high-margin one, too. It's brilliant, really. They're using their expertise to fund the long-term L4 dream. It buys them time and makes them less reliant on just raising capital.
And that brings us right to their financials, because even with the Bosch deal, you need a mountain of cash for this.
Absolutely. Billions. But the good news for them is that they are exceptionally well capitalized right now.
From 2 big events in 2025.
That's right. You had the HK $2.4 billion IPO on the Hong Kong Exchange in November. And just before that, a strategic $100 million equity investment from Uber.
Okay, so cash on hand is strong. But what about profitability? I mean, the free cash flow has to be negative.
Oh, it's definitely negative, and margins are under pressure. If this were a different kind of company, that would be a huge red flag.
But you have to ask where the money is going. Is it an inefficient burn or a strategic one?
And it's clearly the latter. It's a growth-focused reinvestment. The cash is being poured directly back into R&D and critically into fleet expansion and getting those international permits.
And the scale shows that. They already have over 1,500 L4 vehicles operating.
Including more than 700 robotaxis. I mean, this is not a small pilot program anymore. This is a real scaling operation.
Which brings us to their competitive moat. Because it's not just about having a big fleet or cool tech.
Not at all. Their true advantage. It's geography. It's regulatory.
So it's not that their tech is necessarily decades ahead of Waymo's.
It might be. It might not be. But what is definitely ahead is their permit portfolio. They are the only firm with operating permits in 8 different countries.
8. Let's just list them, because it's pretty incredible. China, UAE, Singapore, France, Saudi Arabia, Belgium, Switzerland, and the US.
Think about the legal and political complexity of that. It's a massive barrier to entry. They're already running in over 30 cities.
But the skeptic would say, so what? They're just collecting expensive pieces of paper. Can't a company like Baidu or Waymo just lobby their way in and catch up?
That's the key question. And the data suggests probably not. at least not quickly. What they're building is this technology plus platform plus policy ecosystem.
So once they're in a city, they become deeply embedded.
Exactly. In places like the Middle East or Singapore, they have at least a year-and-a-half lead. They're supplying the data. They're part of the government's long-term planning. It creates really high switching costs.
You essentially lock rivals out by becoming part of the infrastructure itself.
Precisely. And that's reinforced by their partnerships. The Uber alliance is massive for global ride-hailing deployment, and the Bosch deal gives them a strong foothold in the European auto market.
And we've started to see these pieces come together in some major catalysts recently. The Dubai launch was the big one.
Huge. That was the validation moment. It was done with Uber and the Dubai Road Authority, the RTA. It proved the whole strategy works in a major global hub.
And it fits perfectly with the UAE's goal, right? They want 25% of all transport to be autonomous by 2030.
So WeRide goes from being a cool tech pilot to a key partner in a country's national goals. That's a powerful narrative shift.
A shift the market definitely noticed. The Dubai news was the direct catalyst for that 5.7% intraday stock surge.
It was. The market is clearly saying, okay, this is real now. This is commercial.
And the analysts seem to agree the consensus target is up around $13.17. But, we always want to see what the institutional money is doing.
And the flow there is really telling. It's not just one type of fund. You see ARK, which is all about disruptive tech, adding over 101,000 shares.
That's the high growth bet.
Right. But then you also have a firm like Brighton Jones, a big wealth manager, initiating a huge new position, over 444,000 shares.
So you have the growth capital and the long-term stable money both moving in. That suggests a strong consensus.
It does. It suggests they both see this as an inflection point.
So looking forward, what are the key dates? What confirms this momentum?
The big one is the Q4 2025 earnings report. That'll come out early Q1 2026.
And that's where we'll see the first real numbers from the Dubai and China ramps.
Exactly. And we'll also be looking for milestones on the Bosch ADS production. If that starts contributing meaningfully, it really stabilizes the whole financial picture.
Okay, so we've laid out a very strong bull case. We have to balance this. Let's hit the bear case. What's the number one risk?
The valuation. Plain and simple, the price-to-sales ratio is, well, it's high. It's very high compared to the industry.
So the market is pricing in protection, basically. There's zero margin for error baked into that stock price.
None. And that ties directly into the risk of dilution, because they are still burning cash if there are any delays. If the Dubai scaling is slower than expected.
They'll have to raise more money.
And that could hurt current shareholders. You can see that risk reflected in the stock's volatility all year. It's not a smooth ride.
And what about the big competitors? Waymo and Baidu aren't just sitting still.
They're a constant threat, of course. But this goes back to the moat. That global permit ecosystem and the Uber partnership, that's a defense that capital alone can't easily break. If Dubai proves the economic model works, they've effectively ring-fenced these incredibly valuable international markets.
So for an investor, that high PS ratio isn't about today's revenue. It's the market pricing in their goal of having, tens of thousands of robotaxis by 2030?
It's a bet on the 2026 to 2030 scaling story. It's a multi-year hold, not a quarterly trade.
So to sum it all up, WeRide looks like a global L4 leader with a really critical first-mover advantage in international regulatory approval. They're hitting an inflection point where pilots are finally turning into real commercial revenue, and it's backed by strong institutional buying. It's a compelling, but yes, volatile, play on the future of mobility.
A multi-year hold opportunity, betting on that 2026 to 2030 scaling. If you want to keep up with how these global catalysts play out, make sure you subscribe, like, and comment to Smart Wealth with Joshua.